reveals how the game actually works. Before every major crash, there's a period where institutional investors, the banks, the hedge funds, the family offices, the billionaires, quietly reduce their exposure. They sell their positions, they raise cash, they buy protection, they don't announce it, they don't warn anyone. In fact, their public statements often say the opposite. They tell you to stay invested. They tell you the fundamentals are strong. They tell you not to panic. And while they're saying that, they're heading for the exits. In 1929, the Morgans and the Rockefellers started liquidating in the summer, months before the October crash. Bernard Baruch, one of the richest men in America, was almost entirely in cash by September. Joseph Kennedy sold everything after his famous shoe shine boy conversation. But the real reason he sold was that he had connections to people who knew what was happening inside the banks. Regular Americans kept buying. They were the exit liquidity for the smart money. In 2007, hedge funds started shorting subprime mortgages a full year before the crash. Goldman Sachs famously bet against the same securities they were selling to clients. Executives at Countrywide and other mortgage lenders were dumping their personal stock while telling investors everything was fine. Regular Americans kept buying houses and bank stocks. They were the exit liquidity. Now let's look at today. Corporate insider selling has reached levels we haven't seen in decades. CEOs, CFOs, board members, the people who actually know what's happening inside these companies, are selling their stock at a historic pace. The ratio of insider selling to insider buying is at extreme levels. For every insider buying shares of their own company, multiple insiders are selling. Meanwhile, retail investors, regular people, have been pouring money into the market. Robinhood accounts, 401k contributions, passive index flows, record amounts. The smart money is selling. The regular people are buying. This is not a coincidence. This is the pattern. This is how it works every single time. Stage 3 is flashing red. Stage 4 is the liquidity illusion. This is the sneakiest stage because everything still looks normal. Prices are stable or even rising. Trading volumes are healthy. Nothing seems wrong. But underneath the surface, the liquidity that supports the market is draining away. Liquidity is like oxygen for financial markets. When there's plenty of it, everything functions smoothly. Buyers and sellers can transact easily, prices adjust gradually, shocks get absorbed. When liquidity disappears, markets stop functioning. Prices don't adjust gradually, they gap. Small sell orders move prices by huge amounts. Feedback loops take over, the crash feeds on itself. In 1928 and 1929, the Federal Reserve raised interest rates and tightened monetary conditions. They were trying to cool off speculation. What they actually did was drain the liquidity that was supporting asset prices. For a while, nothing happened, and the market even kept rising. People thought the Fed's tightening didn't matter. Then October came, and when selling started, there was nobody on the other side. The bids just vanished. Stocks didn't decline. They went into free fall because there was literally no liquidity. In 2007 and 2008, the same thing happened. The Fed had been raising rates, credit conditions were tightening, but the stock market stayed high. Housing prices stayed high, everything seemed fine. Then Bear Stearns collapsed, then Lehman, and suddenly everyone realized the liquidity was gone. The market dropped 50% in months. Now look at today. The Federal Reserve has raised interest rates at the fastest pace in 40 years. They've gone from 0 to over 5% in less than 2 years. They've been running quantitative tightening, pulling hundreds of billions of dollars out of the financial system. And yet the stock market is near all-time highs. People think this means the tightening doesn't matter. They think we've achieved a soft landing. They're wrong. The stress is already showing. In March 2023, 3 major banks failed in a single week. Silicon Valley Bank, Signature Bank, First Republic. These weren't small institutions. They failed because of a liquidity crisis caused by rising rates. The Fed had to step in with emergency lending programs. They essentially printed money to backstop the banking system while claiming they weren't doing a bailout. Those emergency programs are temporary patches. They don't fix the underlying problem. They just delay it. The Treasury market, the foundation of the entire global financial system, has been showing signs of stress. There have been moments where liquidity in the Treasury market nearly evaporated, the most liquid market in the world, and it's having plumbing problems. This is stage 4, the liquidity illusion. Everything looks calm on the surface. Underneath, the oxygen is being sucked out of the room. And that brings us to stage 5, the trigger. This is the one nobody can